Hey Chris, how are you today, mate?
I'm well, Shane. Yourself?
Very well, thank you. Very well. It's a bit scary. We're here in October already.
Terrifying. So this year has rapidly gone past. I think Andrew was in the office Monday saying that there's 10 weeks or 69 days left in the year, which is frightful. There's a lot of work to get through between now and Christmas.
Indeed, and it's in the world of little people like we've got at our houses. They're very excited about that prospect, but for us adults, it means a lot of stuff to happen between now and then. But
I'll be happy to get through Halloween at the end of next week first.
Now Cam's not with us today, Chris. He's
Subbed him out.
Subbed him out.
Yep.
Yeah, he's unimportant this month. But
Yep.
off chatting with some clients. But I think reflecting, it was it maybe 4 or 5 weeks ago we were sitting here in September and the world felt very different to what it does today.
Oh, absolutely.
And certainly a lot has happened in the last 4 or 5 weeks. So it'd be great today to pick it apart and go through our normal stats, of course,
Yep.
but also share some insights around some of those geopolitical things we're seeing in the world.
Yeah, absolutely.
At this point in time.
Yeah, there's some of it. I think it's just also reflective of how quickly things can change in the current environment, and I guess we'll talk about it. But in terms of expectation and reality, sometimes there can be a bit of a disconnect. So
definitely, yeah. And look, while we were getting the slides together for the next slide, certainly the events in Gaza have been, one of those events that, you can't sit here and at any time and expect that's going to happen, right?
Yeah, exactly.
And suddenly it's a mass humanitarian crisis on top of what's already happening in Ukraine.
Correct.
And, that it can't not have an influence in investment markets in some way, shape or form.
Yeah, definitely. It's interesting though, isn't it, in terms of the number of, if you want to call them black swan events, even though I know they're probably not comparatively to the global financial crisis, but they're hitting us hard and fast since early 2020. It's it's a bit frightening, but anyway, it's
a lot to work through.
Yeah, it is.
So GDP, the slide on the screen now, GDP growth is something we always track for the world.
Yep.
And, again, as we reflected on the past, we see these massive spike and fall through the COVID time. But what we're now seeing is kind of the softening of GDP globally, which goes hand in hand with interest rates.
Yep.
But, are we seeing any changes here, Chris, do you think, or is it kind of still a little bit too early to kind of really pick apart the trajectory?
Yeah, it's far too early. I think I was looking at the chart pack from last month, and if you see the little green uptick, we've got a screen off to the side here, just for the last month there, that didn't exist in last month's chart. So, but you can't pick a trend based on 1 month's numbers. But yeah, I agree with you. It seems to be just sort of leveling out, but too early to discern whether we're necessarily going in one way or the other.
You know what I find fascinating about this particularly GDP? It seems almost every data announcement that comes out, the outlook for GDP changes.
Yep.
Just overnight, Germany were talking about how they expect to have a recession. Great Britain, on the other hand, are talking about how they think they might muddle their way through this.
Yep.
And it's so influenced by data, which is coming through rapidly.
Yep.
But yeah, I mean, we're obviously very interested and intrigued about how this actually plays out.
Yeah, well, definitely. Well, it's going to send, have the influence that we expect it would have on us sort of as we move through time. And as you can see here, we've skimmed that down to Australia. And comparatively to the world, you can see, I guess, on the far side there is that we're still dipping in a GDP sense, and the column chart there also sort of shows that since January 2022 we're sort of slowing down.
And I guess the importance of these GDP numbers, I know we talk about it every month, but it's good to I guess reiterate what it actually means is that, remember, 2 negative GDP quarters is a recession.
Yep.
So when we see these numbers, here in Australia in particular, over the last, few quarters, 0.7 and then 0.4 and 0.4, we're pretty close, right? On the edge of a negative quarter, and I wouldn't be surprised at all if we have a negative quarter at any stage at this point in time. So, but and again, it's sometimes GDP growth or the word recession is a fearful thought.
I was going to say exactly the same thing.
And it doesn't always mean that, right? It doesn't.
Yeah,
we see responses to recessionary environments, which are designed to try and fix issues that are might be present from a recession.
Yeah, absolutely. And I think that's a lot of the work that the central banks are doing currently. Is wouldn't say there's a universal acceptance that we might need to have a recession, but it's trying to smooth it out so that we don't end up in a deep recession where we're looking at, well, let's say that March quarter figure of 2020-ish there, with negative 2.1, that was an aberrant quarter. But, if we look at those numbers sort of 2 or 3 quarters in a row, everyone's going to be in a world of hurt, I suppose. So we're trying to avoid that, essentially.
Agreed, yeah. So, I mean, the CPI and inflation numbers are probably the most topical thing that we hear about nowadays. And I do, sort of sometimes reflect on this and think, in a normal environment, CPI and inflation is not something that households tend to talk about. Now it's the topic of every dinner table at night. And I suppose when we look at this, I mean, and I think this really strikes at the heart of, where interest rates sit today and where we're likely to see things move in the future. And I think this is what's probably fundamentally changed in my perspective on the narrative over the last month, has been that CPI is it's been trending down, but looks like it's getting a bit stuck or a bit stubborn. And with that has brought with it a change of direction about, maybe interest rates are sufficiently high enough at this point in time. We might see a rise or two, but, seemingly the consensus is that we're getting closer, if not at the peak today. But it does feel as though the discussion point is now shifted from how high do rates get to now how long do they stay at this level, and how restrictive do they need to be for longer to really kind of stop inflation and get it back to their sort of target range.
Yeah, absolutely. And in that context, what does then that do for financial stability? So, if we've got higher rates for longer, that makes it more difficult for households, makes it more difficult for businesses, and that creates all sorts of uncertainty. And we all know how markets react when there's uncertainty. Yeah. And I think that's sort of also quite reflective of what we've seen over, the last month since we last spoke.
I think that's a valid call out, because that's exactly what we've seen, haven't we? It's been volatility suddenly is back on the radar on a daily basis. The US is jumping all around the place. Australia's been following suit at different degrees of ferocity on different days.
Yeah, absolutely.
But I think this is kind of really strikes at the heart of our chart. And we're due to see some Australian data come out next week.
Next week, we'll get September quarter. Yep.
Yeah, so that will be, I'm sure we're sweating on that to see what that number looks like, and if it's at or around expectation, it might be something that we hope to see, of course.
Yeah. So we'll wait and see for those numbers. This chart here, essentially, we kind of covered last month, was really just about what has happened off the lows from an interest rate perspective, and it's just interesting to see comparatively Australia versus the United States about the steepness of that curve. So and I guess where the terminal rates are. So looking at that, you can obviously see that the US terminal rates, if we're there, so when I say terminal rates, like how high is the interest rates going to get before they peak? Obviously, the bigger the nominal number, the harder it is for that respective economy. But it's just interesting in the context of the previous chart there, where you can see the US has a higher terminal, I guess, interest rate, and therefore their inflation numbers are lower than ours. So it's just interesting to see, the US story might be slightly differently to the Australian story. And to your point before about different economies like the UK potentially muddling through potential US recession, each of the central banks have taken their own approach to this, and subsequently we're going to have varying outcomes that push and pull.
Agreed. And look, if you look at Australia and America as a comparative point, I mean, and I know we've talked about this in previous sessions, but I think, again, it's important to kind of revisit around the way our interest rates work relative to our housing. So, I mean, the Australian interest rates are directly linked to the debt levels or the debt rate at which debt holders service, whereas in the US, home loans aren't pegged to their official cash rate. So they can be a bit more aggressive because they don't necessarily hit their households immediately. And they've seen that, and that's why we're seeing that sort of higher. And it probably speaks a little bit to the reason why the currency is jumping all over the place as well, because of this disparity between Australia and the US. But I think we'll see more of this in the weeks ahead, and certainly I think the kind of the important part about interest rates and the back end of inflation is that risk-free rate of return that we can all attract, being be it a government bond or a guaranteed term deposit by government. Kind of the risk assets. There's a premium we should be getting from over and above what the risk-free rate of return is when we invest in a risk asset like shares or real estate. And when it's uncertain outlook, that's why those risk assets jump up and down.
Yeah, correct.
And I think unfortunately, it probably feels like that's more of what we're going to see for at least the foreseeable months in the lead up to Christmas.
Yeah, absolutely. And I think my kind of view on this has been, we'd sort of know more by Christmas this year. If you had asked me that earlier in the year, but I'm with the higher for longer. I think that pushes into early 2024. And I was listening to a podcast this morning that expectation, at least within the marketplace, is for some rate cuts for next year. A few months ago, they had priced in sort of 2 or 3 by mid 2024. They're starting to push out to 2025 now. So I think to your point before, there's a not necessarily like a growing consensus, but the market's sort of expecting for this to be the kind of not the norm, but the environment we're in for a longer period of time.
Agreed. Yeah, agreed. So wages, unemployment, again, very important data, and the significance of this is it does strike again to inflation, right? Because one of the key things that the central bank kept talking about, or the Reserve Bank in Australia more so, is that we have seen kind of wages get stuck in inflation, and that's kind of one of the stickier points in inflation. So what they've been really kind of eager to see is some trending down of wages growth, which sounds a little bit unpleasant in a way for the people who are getting decreases in their wages.
Absolutely.
But if you could look at it from a kind of a macro level, that it is a good thing to kind of see some wages declining, and I can see just a very, very small tick down at this point. So it's hard to say whether that's the new trend is beginning.
Yeah, correct.
But the fact that it is trending down, I'm sure the Reserve Bank is looking at that, thinking that's a better sign than going the other way.
Absolutely, and I think in all the minutes that the Reserve Bank have put out over the last 6 months is, and similarly for the Fed in the US, that service sector or wages inflation has been the thing that they've been most concerned about, and so they're leaving interest rates higher in order to curb some of that. And if that starts to show through, as we talked about before, 1 month doesn't make a trend, that will hopefully, in the context that we're all looking for some interest rate relief, start something of a data set that they can use to justify that decision if and when it comes.
And I think also too, the other kind of contributing factor here is, of course, that Australia has been able to open up to immigration since obviously the COVID lockdown's finishing, and with that brings more people available to work, fill shortages, and it still seems to me, this is purely anecdotal, but it still seems to me that people are still finding it difficult to get skilled labour or even unskilled labour in some instances. So that kind of people coming to Australia and being able to fill roles, I think will help a little bit to this. When you've got more supply than we have demand, then it sort of will bring down some wages. In theory, that's economic theory, Chris. Let's see whether theory comes to life or not. But
it was funny, you were talking about that, and I was like, that's not going to help housing affordability at all.
No, exactly right.
But we'll see how that plays out.
Yeah, business and consumer sentiment, again, a very interesting chart to track. And I've actually found when you look at all these slides in sequence, they're quite interesting as sort of a set of data. And sentiment, when you look at those levels there, we're at lows not seen for over a decade. And it's which I think it probably speaks to that kind of degree of uncertainty again back about interest rates.
Absolutely.
Households are feeling some pressure with rising debt levels. Businesses are feeling some pressure with the uncertain outlook as to whether they invest in their business or whether they just hold tight. So when you get this kind of real uneasiness about what the outlook looks like, there's no surprises that sentiment is sitting down pretty low. Yeah,
absolutely. And everyone's obviously feeling their pinch. So, compared to, I think there's a chart in here, around the savings ratio there. You'll see it, that red line down the bottom there. You come off the highs of COVID, and even you take a normal trend line, the savings ratios are probably below average. It just feeds into that uncertainty because people are not sure, do we have enough money? Interest rates are high.
And if you even think about the other end of the spectrum where, let's use a retired person as an example who have kind of paid off all their debt, not necessarily interest rate sensitive. But what, we're hearing from clients is they're kind of you know, reluctance to maybe do travelling as much as they did previously because the cost is so prohibitive.
Yep.
And even there's price points in everyone's kind of world where we're feeling different pressures that may not necessarily be specifically interest rate pressure, but that pricing is a real problem today,
absolutely.
and that again flows right through to sentiment, right?
Yeah, well, and those price pressures, right, then it costs more, so then I need to use more of my asset base in order to fund that cost.
Yeah.
And then that creates uncertainty because, is this sustainable? And, that it's all about the psychology really, isn't it? So it's...
Indeed.
There's no answers yet though.
Yeah. Now, this is interesting. I think we sort of touched on this slide, maybe a few months ago perhaps as sort of...
It was around March-ish.
And I think it's a great slide to share again because... This is the stuff that we talk about all the time behind the scenes, right, around what are the likely scenarios in regards to, the investment outlook. And when you look at it there, I mean, the left-hand side of this, the smooth rebalancing, is kind of been the best case scenario that the world is, and the central banks have kind of been trying to orchestrate. But what we're probably seeing now is a bit of a slip towards the right-hand side there, where we see macro volatility back in vogue for the reasons we just spoke about.
Absolutely. And I think markets have been pricing in a smooth rebalancing for the last 6 months, which is also some of the reason for, people are starting to realise that macro volatility is probably the more likely outcome. And subsequently we've seen, both risk assets and defensive assets sort of really all over the place for the last month or so, which we'll kind of get to in the next couple of slides. But this one here just really is that same chart with on the right-hand side there is the CPI inflation at the top, the Fed funds rate year on year in the middle, and then the real GDP growth. So it gives you and the green arrows show us the point in time where we are now from that chart previously here. So you can see that, with the CPI inflation, in terms of the actual rates, we're very much in line with that kind of macro volatility view. You could even potentially argue on the major recession side, but they're relatively similar at the same points in time. But the Fed's funds rate is higher than what we would expected. So that middle chart, smack bang in the middle there, the higher for longer. That's kind of really what I guess markets are expecting now. And the real GDP growth is definitely more reflective of, I guess, that macro volatility piece. So, if you're looking at those sort of three data points, it speaks to that's on the balance of probability where we'd expect to be. And because markets have been pricing in that smooth rebalancing, this has happened.
Yeah.
So, if you look at the left-hand side there, September, with bond markets, the 6-month returns were close to zero. And then you push forward a month, and we're looking at sort of -4 globally and -3 within Australia. That says something about concerns about where things are headed.
Yeah, and I think as you look at this information, and sometimes it's hard not to get kind of a bit worried about it all.
Yep.
And it's human nature is such that we should be concerned and worried about things of this kind. And I know we'll talk about it shortly, but again, trying to invest through this, that's the difficult decision as to how you actually allocate your capital, right?
Yeah, absolutely.
And we'll talk about diversification as we always do, but I think that's the key here, right? Is that with that sort of longer for higher with rates and that sort of macro volatility, the key in all that is that in a month's time we might see a very different data set again, be it positive or negative.
Yep.
But that really speaks to an important decision point that investors need to make, don't they, to kind of just continue to hold their cycle through, hold their investment through a cycle.
Absolutely. And the way I think about this is that, in the setup, in the structure of your portfolio, it needs to be very much aligned to, what your life looks like.
Yep.
So what are your actual needs rather than kind of just picking a this growth defensive portfolio and going, that's the answer.
Yeah.
In the current climate, and to be honest, I guess economic conditions are always like this, but particularly so in the current climate, that is so important because it means you're not being forced into changes that aren't dictated by you. In the sense of not having the control of your outcomes, I guess.
Totally agree, yeah. And it's such a good call out, isn't it? Because that's what we talk to our clients about all the time. And, that sort of building a portfolio which is, specific for their requirements, I think I agree with you. It sort of holds more value today than it probably ever has.
Yeah, definitely.
With this kind of, you know, risk on, risk off world, and
Yep.
I feel for all of us and investors that have kind of living through this era, because, you know, positively we'll find we'll get a lot of experience out of all this for the whole world about things that happen and how the world behaves. But secondly, it's been a long time now though, right? We've got March 2020,
Yeah.
and we're still kind of dealing with not necessarily the health aspects of COVID, but we're now still continuing to deal with the financial implications of
Absolutely.
QE and
Yeah, definitely.
stimulus.
Well, there's even, like, talking about QE, there's some definite overhang still from the financial crisis around debt levels, and
Yeah.
you know, that's a kind of underlying theme that's going to play into, well, what are the policy tools that central banks have at hand?
Yeah.
You know, depending on what happens into the future. But yeah, this period, yeah, particularly has been tough, I think.
Yeah.
Because we'll be 4 years in March, so
Yeah.
you know, that's a long period of time.
Yeah, well, equity markets, on the other hand, we've seen the volatility come back again, as you see to this chart here on the right-hand side there. But when you look at the headline numbers, they've been pretty healthy, and I sort of feel as though, you know, I'm a bit torn by these numbers, I must say, because, like you made a great point before, Chris, you said that equity markets have been definitely factoring in the soft landing.
Yep.
And now we see volatility returning as we shift a little bit to that right-hand scenario, and that's what we're living through right now with respect to.
Yeah.
And I mean, this week's been a pretty strong week, but last week was pretty ordinary,
Yeah, it
right?
was terrible, yeah.
You know, so it's kind of, again, data comes out and the markets are so reactive, because it feels to me as though the world is hanging on, just trying to find any piece of information it can
Yep.
to make an informed decision about what's likely to happen next.
Yeah, absolutely. And in any market, really, you're forward looking. So you're looking 12, 18 months in advance. So you're mining these data sets for trends to be able to move in expectation of what things might look like.
Yeah.
And there's been a material shift, I guess, in the market zeitgeist's view about where things are headed. And I suppose, you know, in terms of when talking to clients, what should we expect? I think realistically we should expect more of the same for, you know, at least until Christmas, and then hopefully the data sets. But again, we're data dependent, right? Where the data sets start to give us some information that's showing more of what we want to hear, hopefully.
Yeah, agreed.
Right, so that's just a bit of a chart of the last month, which is a reflective of what was in the previous one. But as you can see, you know, we've also had a pretty poor month on the share market side, but who knows?
Yeah, and it probably meant that we've given back some earnings that we saw in July and August in this
Yep.
financial year, right?
Yep.
So July and August are pretty strong.
Yep.
And then, you know, September, weaker month and very uncertain month. And again, reflecting here. But so, you know, it's a line in the sand time, isn't it? Where you pick a day to say this, we're going to report today. And, you know, it
it's hard, isn't it?
Yeah.
So you look at the 12 months reporting from, say, maybe 6 weeks ago, you know, returns look spectacular. We're looking at sort of like 13-14% returns for that 12-month period. And then, you know, you back it out another 12 months and... Yeah.
It's very different, right?
Yeah, exactly.
And it's amazing. I mean, I must say my mood changes when I wake up and I look at the market every morning. I wake up and if I see green lines on my phone when I look at the US, I'm like, oh, it's going to be a good day today.
Yeah.
You see red lines and it, you know, I don't change behaviour, but it's still kind of mood-wise, it does, you know, has a bearing on it. On
I'm sure
sentiment.
you're not the only one doing that.
Yeah. Well, I must say, Chris, this is my favourite slide of all things, and you know, we run the risk always of sounding like a broken record, but I feel as though it's such an important message that we continue to talk to people about, you know, market timing and diversification of portfolios.
Yeah, it's just, you're right. I do feel like, you know, it sounds like a broken record coming back every month, but it's so important. It's like just having your portfolio aligned to the things that you need from it as an individual, at an individual level, from your overall structure, and then having the diversification once you've made that decision, and the ability to hold through the cycle is, that's where, you know, you're setting yourself up for success in order to, you know, live the life that you want.
And I think it's so important to keep that sentiment in mind, because, you know, it's, you turn the news on at night and, you know, you kind of can't help but get concerned about, you know, we talked before a little bit about Gaza and Ukraine, interest rates, inflation, et cetera, and it's news channels always push out bad information. It does have a bearing on our sentiment. Then you see, you know, kind of some of the economic discussion about, oh, we should do this or should do that. But the reality is that no one's got a crystal ball.
No.
And I always have a degree of cynicism anytime I see any kind of bold economic projection or forecast about anything, because history shows that people don't call it right.
Yeah, absolutely.
These charts are great just to reflect on and think, okay, we're structured okay.
Yep.
We're going to experience volatility in moments in time where things aren't, sitting okay.
Yep.
But if we, maintain our nerve and kind of work through the cycle, then, invariably we'll be okay in the journey.
Absolutely. Yeah. It's never as bad as you think it is, and it's never as good as you think it is.
Yeah. That's a good way to surmise. And the final piece here, of course, today, as always, is a general advice discussion, which simply means that we're talking about concepts at a general level. As you need specific advice, or if we haven't been on the front foot with you to talk about this specifically for your personal affairs, of course, you need to speak to one of us about, making sure what we're talking about is specifically aligned to your personal affairs.
Yeah, absolutely. Yeah. And just, coming back to that theme of, it's got to be aligned to, your circumstances. And this is obviously very general in nature.
So, well, thank you for dialing in. I hope everyone's here at the end.
Yes.
And if they are, I'm sure they've enjoyed our discussion.
Congratulations.
Yeah. And we're back online in November with hopefully something different to talk about from a market sense.
Yeah,
so until then, take care.
Thanks, Shane.
Okay, bye for now.